In April 1933, Franklin Roosevelt signed an executive order making it illegal for ordinary Americans to own gold. Every coin, every bar, every gold certificate had to be surrendered to the Federal Reserve by May 1st. The compensation rate was fixed by the government. The penalty for non-compliance was up to 10 years in federal prison and a $10,000 fine. The official explanation given to the public was that gold was choking the economy and the country had no other option. That part is largely accurate. What the standard version of this story tends to leave out is that the legal authority used to pull this off was borrowed from a world war that had ended 15 years earlier, that the government immediately revalued all the gold it collected at a significant profit, and that the level of control Washington gained over American money in those few weeks was never meaningfully reversed. This video is about how that happened, why the standard economic explanation only covers part of it, and why the decisions made in early 1933 still shape how money works today. If you're new to this channel, subscribe and share this video before we get into it. There's a lot more history here that doesn't usually show up in the standard accounts. To understand why what happened in 1933 was possible, you have to start with what the country actually looked like going into it. The crash of 1929 is usually treated as the starting point, but the damage accumulated slowly and unevenly over the following years, which made it harder to respond to and easier to underestimate. By 1932, industrial production had fallen by roughly half compared to pre-crash levels. Unemployment was somewhere between a quarter and a third of the workforce, depending on how you counted it. And that's before accounting for the people who had given up looking for work entirely. Farm prices had collapsed to the point where growing crops cost more than selling them was worth. Farmers in some states were destroying food rather than hauling it to market at a loss. Banks were failing in waves, not individual banks here and there. Entire regional banking systems were collapsing. Between 1930 and 1933, thousands of banks failed across the country. Each failure wiped out the savings of depositors who had no federal insurance to fall back on, because deposit insurance did not exist yet. The psychological effect of this accumulating over 3 years is difficult to overstate. By the time FDR was inaugurated in March 1933, the country had been watching financial institutions dissolve for long enough that confidence in banks as a category had broken down in significant parts of the population. People weren't irrationally panicking, they were responding reasonably to a pattern they had watched play out repeatedly. The logical thing to do, given what they'd seen, was to hold physical gold rather than paper that depended on a bank staying open. The gold standard was the structural constraint underneath all of this. Every dollar in circulation had to be backed by gold held in Federal Reserve. The system was originally designed to prevent governments from printing money irresponsibly and causing inflation, which is a real problem and a reasonable thing to design against. What it wasn't designed for was a deflationary spiral during a generational economic collapse, when gold backing limited how much currency could exist, and when fear was driving people to pull cash out of banks and convert it to gold. The supply of money available for actual economic activity kept shrinking. The Federal Reserve couldn't inject liquidity into failing banks without the physical metal to authorize it. It couldn't fund recovery programs. The mechanism meant to prevent one kind of catastrophe had become the ceiling on what anyone could do about a completely different kind of catastrophe. That's the economic case for what happened next. It's real, it's documented, and most economic historians accept it as the core explanation. It just isn't the complete picture. FDR was inaugurated on March 4, 1933. Within 2 days, he declared a national banking holiday and ordered every bank in the country closed. The stated purpose was to stop the bank run that was spreading state by state and give Congress time to pass emergency legislation. What actually happened in those 8 days reshaped the legal and financial architecture of the country in ways that extended far beyond stopping a panic. The Emergency Banking Act moved through both chambers of Congress and was signed into law on March 9th. The entire legislative process took under 8 hours. That's not a metaphor or an approximation. The House of Representatives passed it by voice vote without a printed copy of the bill being available to most members. The speed itself tells you something about the atmosphere in Washington at that moment. People in positions of authority genuinely believed the system was days away from a collapse that would be unmanageable. When the banks reopened the following week, deposits came back in faster than they went out, which is usually credited to a combination of the legislation and FDR's first fireside chat, where he explained the banking system to a radio audience in plain language and told people it was safe to bring their money back. The psychology of that moment is worth paying attention to because it becomes relevant to understanding what came next. The administration had demonstrated in real time that public confidence in financial institutions was something that could be actively managed through communication and visible action. That insight shaped everything that followed, including the gold order. On April 5, 1933, Executive Order 6102 was signed. The order required all persons in the United States to deliver their gold coins, gold bullion, and gold certificates to the Federal Reserve by May 1st. Compensation was paid at the official rate of $20.67 per troy ounce. There were limited exemptions, amounts under $100 in face value, gold used in industry, dental gold, jewelry. Beyond those exemptions, holding gold after the deadline was a federal crime. The penalty language in the order was not vague. It referenced criminal fines and imprisonment, and while enforcement was inconsistent and prosecutions were relatively rare, the legal exposure was real. What almost never gets mentioned in summary accounts is the legal authority the administration used to justify any of this. They did not pass a new law creating a gold confiscation framework. They used the Trading with the Enemy Act of 1917, a piece of wartime legislation passed during the First World War that gave the president broad authority over financial transactions during a declared national emergency. The argument the administration made was that the economic crisis constituted a national emergency in the relevant legal sense. The courts largely agreed when challenges came, and the constitutional questions raised were mostly set aside rather than clearly resolved. This is significant not because it means what FDR did was necessarily wrong, but because the legal mechanism matters for understanding what kind of action it was. Using a wartime emergency law to compel the surrender of a physical asset held by private citizens is a different category of thing than passing economic legislation through normal channels and treating them as equivalent flattens something important about the actual history. Then there was the revaluation. After the gold was collected at $20.67 per ounce, Congress passed the Gold Reserve Act in January 1934. The official gold price was reset to $35 per ounce. The government had paid one price for the gold it collected and was now holding it at a price nearly 70% higher. The difference funded a currency stabilization fund. This is not a conspiracy. It was public policy, documented and reported at the time, but it tends to get dropped from the simplified version of events in favor of the cleaner economic narrative. The standard economic explanation for the gold order is coherent and defensible. Removing the gold constraint gave the government the flexibility to expand the money supply, fund New Deal programs, stabilize banks, and eventually finance a Second World War. All of that happened. The question worth sitting with is whether the economic outcome was the primary logic driving the decision, or whether it was the publicly acceptable framing for something that was also operating on a different level. inside the Roosevelt administration, particularly among the economic advisors who had absorbed the monetary thinking circulating in academic circles in the early 1930s, there was a serious argument being made about public psychology as a driver of the deflation spiral. The claim was that people were hoarding gold not primarily because of rational economic calculation, but because gold felt real and stable in a way that paper currency didn't. As long as gold existed as a private alternative, confidence in the dollar would always be conditional. People would shift to gold when things felt uncertain, and the act of shifting would make things more uncertain, which would cause more people to shift. The proposed solution to this cycle was to remove the alternative. If there was no gold to run to, the dollar became the only option, and confidence in it would have to be maintained rather than abandoned. This is a behavioral argument, not an economic one in the traditional sense. It's about managing mass psychology rather than optimizing monetary mechanics, and it carries different implications for how you think about what the government was actually doing and what authority it was actually exercising. There are people who read that argument as legitimate crisis management, and there are people who read it as the government deciding it had the right to override individual financial choices in order to control collective behavior. Both readings are based on the same facts. Which one you find more persuasive probably says something about your prior beliefs about the relationship between government authority and individual economic freedom. But the argument itself deserves to be stated clearly rather than buried under the economic explanation that's easier to present without raising those questions. The compliance rate with the gold order was high but not total, and the variation in how different people responded is one of the more humanly interesting parts of this history. Most Americans who held gold in the ordinary ways, coins, certificates, small savings, turned it over. The combination of the legal penalties, the compensation offered, and the general climate of wanting to cooperate with what the government was framing as a national emergency produced substantial compliance relatively quickly. But not everyone surrendered everything. Some people kept coins as collectibles, which was technically outside the exemptions but practically difficult to enforce. Wealthy families with substantial gold holdings made use of the industrial and artistic exemptions more creatively than was probably intended. A meaningful amount of gold simply moved offshore or into informal storage. The Treasury and Federal Reserve received large quantities of gold, but independent estimates of what was held privately before the order versus what was actually surrendered suggest the collection was incomplete. This is not surprising. It's extremely difficult to enforce any law that requires the surrender of a small, portable, easily concealed asset with inherent value. The enforcement resources devoted to the order were limited, prosecutions were few, and the government's primary goal was the large-scale compliance that would allow monetary policy to function differently, not the elimination of every privately held gold coin in the country. What happened to the people in between? Not the wealthy who had options and not the poor who had nothing to surrender, but the ordinary working Americans who had spent years accumulating modest savings in gold as a hedge against exactly the kind of financial collapse they had just lived through, is a piece of this history that doesn't get much attention. For those people, the order arrived at the worst possible moment. Their savings, accumulated precisely because they didn't trust institutions, were now being redirected into the institutions they didn't trust, at a government-set price under legal compulsion. Whatever the macroeconomic justification, that specific experience was something different. American citizens were legally prohibited from owning gold coins or bullion from 1933 until December 1974. 41 years. During that period, the United States built the international financial architecture that still shapes global money today. The Bretton Woods Agreement of 1944 established the dollar as the world's reserve currency and pegged other currencies to the dollar, which was itself pegged to gold at $35 per ounce, the rate set immediately after the 1933 confiscation. Every country that signed Bretton Woods was essentially trusting that the United States would maintain the gold backing of the dollar at that fixed rate. For 2.5 decades it held. Then in 1971, with inflation rising and foreign governments increasingly requesting physical gold in exchange for the dollars they held, Nixon suspended convertibility. The dollar was no longer backed by gold for any purpose. It became fully fiat currency, backed by the stated credibility of the US government and the scale of the American economy, nothing more and nothing less. The line from 1933 to 1971 is direct. An emergency measure to stop a banking collapse became the foundation of international monetary policy, then the basis of a global financial system, and then eventually the justification for eliminating the gold backing entirely. None of those subsequent decisions were inevitable consequences of the 1933 order, but each one built on the precedent and the infrastructure established in those early weeks of the Roosevelt administration. The simplified account of 1933? Gold standard was choking the economy, Roosevelt removed it, recovery became possible, is not wrong in its broad strokes. It's incomplete in ways that matter. The mechanism used was wartime emergency law, which raises legitimate questions about the scope of executive authority. The revaluation that immediately followed transferred significant value from the people who surrendered gold to the government that collected it. The behavioral logic behind the order was about managing public psychology, which is a different justification than optimizing monetary supply. And the prohibition lasted 41 years, which makes it something other than a temporary emergency measure by any reasonable definition. These elements don't fit cleanly into the economic efficiency narrative, so they tend to get compressed or omitted when the story is told quickly. That's how most history gets transmitted. The parts that fit the explanatory frame survive, and the parts that complicate it get left out. Understanding what actually happened in 1933 requires holding the economic argument and the other arguments together at the same time, even when they pull in different directions. The relationship between American citizens and physical money changed permanently in the span of a few weeks in April 1933, using legal authority borrowed from a war that had ended 15 years earlier, during a financial crisis that was real, but also happened to justify a level of executive action that would not have been politically possible under ordinary conditions. The economic consequences were significant and largely positive by the measures economists use. The other dimensions of what happened, the legal mechanism, the revaluation, the behavioral logic, the 40-year prohibition, are part of the same story, and they're worth knowing. If this is the kind of history you want more of, share this video with someone who would find it useful, subscribe so you don't miss what's coming next, and leave a comment below with whatever piece of this you think deserves more attention. There's a lot more where this came from.